public expenditure. We want to understand what are the economic roles that governments perform. First, let us appreciate how important government is quantitatively. Public expenditure as a share of GDP ranges anywhere from a low of around 15% to as much as nearly half of economic activity in countries. So what we're talking about here is quantitatively important. It's also, as we're going to see as we go through the roles, qualitatively important. Public finance is the study of government expenditure and tax policy and of their impact on the economy. So with that, what are the economic roles that governments have performed? There are three. The first is resource allocation. Economics is about how resources are used and who gets it. Governments don't leave the production of goods and services only to the private sector, to private entrepreneurs. Governments directly usurp some productive resources and produce goods and services for themselves. They get involved in the production of goods and services in various ways because markets left to themselves are not going to achieve the best societal outcomes. And the reason for this is what is called market failure. Market failure describes a situation in which the freely determined price, the market price, fails to reflect all the social costs and benefits of a market. Markets fail for a number of reasons. The first one is the case of what is called public goods. Public goods describes goods and services that by their nature, it's difficult for a private entity to provide those goods and services and to be able to make money off of it, to be able to monetize that provision, and so to make a profit which incentivizes a private company to do it. The characteristics that makes a good or service a public good is that it is non-rivalrous and it is non-excludable. Because those characteristics applies to goods and services that we actually want, like public security and road signage, then we can't wait for the private sector to provide it. In most cases, we won't have it. So governments have to provide those. Markets also fail when we have externalities. Externalities is where the activity of the transaction between the private buyer and the private seller has costs or benefits to parties that are not a part of the transaction, to external parties. If both sides of the market don't have full information about the product, if either the buyer or the seller doesn't have full information about the nature and quality of the product, then markets don't perform best left to themselves. That's the problem of asymmetric information. If a business is able to exercise market power, if it has a certain degree of loyalty or a certain share of the market and the consumers are for whatever reason committed to buying from this particular company, then that company will maximize its profit at a price and at a quantity that doesn't necessarily maximize the social good. So again, in such a market, where the businesses have monopoly power, the market left to itself doesn't give you the best outcome. And there's the case of what is called merit or demerit goods. Markets are good at capturing, much of the time, the economic benefits and costs. But certain goods and services provide benefits or will cause harm that are not economic in nature. One example is the benefits of having an educated society. An educated citizenry leads to more public engagement and to a better quality of political discourse, which is going to lead to better outcomes for the citizens. But that is not strictly an economic matter. Political engagement is not an economic matter. The quality of public discourse is not a strictly economic matter. Therefore, education is a merit good. There are also demerit goods, such as certain illegal drugs or alcohol that have detrimental social consequences. And so governments have an interest in encouraging or having a greater production of merit goods and less production of demerit goods. So these are all reasons why governments want to get involved in the allocation of resources in what is produced. So that's one reason for government's involvement. Another one is that governments engage in redistribution. Redistribution of income, redistribution of wealth. Free markets can allocate income reasonably fairly given the productive endowments with which households begin. But those productive endowments are not necessarily equitably distributed in the first place. The productive endowments that a household has, the amount of labor in the household, its ownership of productive assets like human capital and physical capital, might have been the result of historical circumstances. Very often is a result of historical circumstances and not due to the effort and the investment of that particular household and the individuals in that household. In that case, an unfair and inequitous distribution of initial productive endowments leads to an unfair distribution of income. And so governments legitimately feel that they can get involved in trying to redistribute income away from who would otherwise receive it in a free market economy to others. The third justification, the third motivation for a government having an economic role is in macroeconomic management. Total output in an economy, its real GDP, tends to fluctuate from year to year around the trend value. But these cyclical fluctuations are not desirable because most of us prefer to have a smoother standard of living from year to year and not be employed in some years and unemployed in other years. And so governments try to smooth out an economy's cyclical fluctuations. This is called stabilization policy. That is one aspect of macroeconomic management. The second aspect is the trend value around which those fluctuations take place. Governments try to promote economic growth, to have that trend value be rising over time instead of stagnant. And that over time leads to a higher standard of living for the residents of a country. So, allocating resources, redistributing income and wealth, and managing the macroeconomy are the three roles that governments tend to perform. We may call that the what of government's involvement in an economy. But what about the how? In pursuit of these goals, these purposes, What are the ways in which governments intervene? Well, governments intervene actually at all levels. Governments get involved directly in the production of some goods and services. Governments produce public security. Governments collect garbage. Governments provide education. Public schools. At another level, governments will leave the production of goods and services to private businesses and get involved only in the distribution. So governments have been known during pandemics and other crises to get involved in food distribution. At a higher level, governments will leave both the production and the distribution to the private sector and simply regulate the market, regulate the industry. This is the case, for example, with the banking industry. And finally, governments sometimes are only involved in incentivizing and disincentivizing the decisions that private businesses make. They try to create a disincentive for some businesses, for some activities, by levying an extra level of taxation, or they may incentivize certain activities by using tax credits, for example. So many governments around the world try to preserve a higher share of agricultural activity in the economy than would otherwise obtain if left to itself. This is true of the European Union, and this is true in the United States. So governments will produce directly, they will distribute what others produce, they will regulate, or they will merely incentivize and disincentivize. The economic roles of government are due to them wanting to correct market failures, to redistribute incomes, and to promote stabilization and growth.